Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching the channel. Thank you for hitting the subscribe button. I definitely appreciate that, as well as all the comments. Today, we're going to look at Johnson & Johnson stock. As we always do, we're going to look for 5 key attributes, and we're going to go through the 10K most recently. We're going to look at 8 years of historical financial information, figure out what we think the value of the stock is and where it could go in the future, and see what kind of the economic return we might be able to get if we bought the stock today. But the first thing is we look at the 5 key attributes for all stock investments. The first one being top line revenue growth. Second one is earnings growth, as we look at EBITDA, remember on the enterprise value level, EBITDA for earnings, cash flow growth, low debt, and a well-priced stock. All 5 key attributes mean for us, it's a qualifying investment for consideration. What I do here in this channel is a math exercise to see if the numbers smell check. It's then up to you to figure out, does the business have long-term positive economic capabilities? What's the competitive landscape? Is there a moat around the business? Is management competent and doing the right things? Those are all secondary but also very important considerations for this channel. For time consideration, we just crunch the numbers and give you what the cash flow is. Okay, let's look at the 10K behind me. This is their fiscal years ending 2019. So that's as of the end of December. This is what now, June? It's August. Oh God, it's August. 2020 is almost over. But so there's 6 months of new data that's not reflected in these numbers. We look at everything on an annual basis, so we're gonna pull the 10K. And a couple of things I wanna point out that I really liked when I read through this. For starters, they've got this credo up front. It goes through their mission statement and who they are, what they stand for. I like that, and it's nice to look at how the business, how management sticks to this credo as they make investments and decisions time and time again. So read this, go through it. I think the shareholder letter is very interesting as well. What I wanted to point to is on page 31. So page 31 is, I should have had it queued up, but I did not. Here. There you go. So one thing I like to see is perspective. That's what we try to do in this channel. That's why I look at 8 years of financial history. Behind me is a decade of Johnson & Johnson's financial performance that they put right into the 10K. It's fantastic. A lot of times you'll see 3, 4, maybe 5 years, but they just give the full decade, which I appreciate. And it's a good kind of honesty and check on management that they give it to the shareholders as easily. And they pull out a lot of the key attributes that we look for. Top line revenue growth, they mentioned debt, they mentioned cash flow from operations on here. Really easy, kind of at a glance, and I think more companies should do this in their 10K disclosures. But I really liked it. The next thing I wanted to say is how they break down the business. So as you know, their sales, they're a monster healthcare company. They're in medical devices. They have prescription drug products, and then as well as just over-the-counter medicine and products such as Band-Aids would be one just example of the brand names that they have. Well, when you look at their business as a whole from revenue perspective, where revenue comes from, it's basically the 3 different facets of their business, and within each facet they have a number of diversifying factors. As an example, this would just be major consumer franchise sales, so not medical devices, not prescription drugs. This would be something like Band-Aids. I think they own Theraflu. There's a couple on here. Oh, Neutrogena they own. So these types of brands are in this bucket. This bucket represents $13 billion of their total revenue, and is only a fraction. And you can see even that fraction is broken down into different pieces like beauty, over the counter, and that really helps the diversification of revenue. If you get past the consumer over the counter focus into pharmaceuticals, you can see they break out a whole litany of all the drugs that they own, how much revenue it comes from, and what sector of the medical field they come from. And really what the takeaway for me was real diversification. They're not dependent on a particular drug that drives revenue, and should that patent expire, they would lose a big section of their business. It's quite the opposite. It's really diverse, and it's nice to see that. Last thing was the medical devices. So here's medical devices. surgery, you got vision down below, kind of the distribution of revenue. Again, all very, very diverse. So I think that for us is a moat when you're doing the checks outside of just the numbers. What you're looking for something like this. Okay, let's go dive into the numbers and take a look. Before we do that, I wanted to do two more things. First, Johnson & Johnson is currently a defendant in a lawsuit about their talc that's in the baby powder, and you'll see that as a dip in the financials, dip in the market value when we look historically. That's still yet resolved. I don't know where it's going to go, but I'm not reserving any money. I'm just letting the numbers play out. The other piece is COVID, right? Johnson & Johnson is fighting for or trying to develop cures or a vaccine for this. They're in this fight with all the other pharmaceutical companies that are looking for cures. I haven't modeled in any windfall in profit or cure. I'm not even sure the government would allow them to keep profit if they were to succeed. They might have to give it away just for mankind purposes, let alone trying to make a profit. So none of that's aside. I want the numbers to pencil out on their own, and then if there is any kind of gain to be had through a settlement on the talc lawsuit or COVID vaccine, that's kind of upside to the model, but it's too unknown for us to model. All right, without further ado, let's go dive into the numbers and take a look at Johnson & Johnson. So behind me is 8 years of revenue that they've achieved. 2011 with roughly $65 billion of sales, growing that to $82 billion in 2019, last fiscal year. That's a 3% annualized growth rate, which is about double inflation. Inflation is maybe 1%, 1.5%. This is 3%. I think that checks that box, and it's mild growth, but for a broad, diversified pharmaceutical drug company, you kind of expect that. So I think that's smell checks. EBITDA, remember EBITDA is our earnings at the enterprise level. That's the way we look at a business, not an earnings per share. We want to make sure the entire business is penciling out, and then we buy a piece of that, which is our share price. So that starts at $19 billion and grows to $28 billion. The annualized return there is 4%. 4.7%. So they're growing their EBITDA faster than revenue, which is good. That means margins are growing. They started at 19, they moved up to $28 billion. So that checks the second box, which is earnings growth. Let's look at enterprise value and see if they're expensive relative to enterprise value. We start with the debt. So the debt piece, $14 billion. It has grown to $28 billion. What's not in here is an employee liability. And you can find that if I go to the balance sheet. I think this will work. Let's see how fast I can pull that up. Yeah, so on the balance sheet, they carve out debt, employee-related obligations right there, and it's $10.6 billion. That's a debt that is not included in total debt. But it's there. It's obviously an obligation for pensions that they have promised former employees. So this debt here is just long-term and current portion of long-term. You need to add the $10 billion onto that. I have not. This is just straight long-term debt. So long-term debt, then cash. We're pulling excess cash. Remember, excess cash, the way I look at it is marketable securities. But if you notice, on the balance sheet, they ended fiscal year with $17 billion of cash, right? Marketable securities or the cash equivalent notes, marketable securities line, $1.9 billion. Looking historically, they seem to have included a lot of cash in the marketable security line and for whatever reason transferred it to the cash and cash equivalents line. So that's what this drop here is, but they still have the cash. They have $17 billion cash on hand. So I wouldn't take this drop as them missing cash. It's just reclassified and didn't pull up when I did the search. So they do have plenty of cash on hand. Market cap, again, refresh market cap, shares outstanding times market price, you get market cap. We add market cap, debt, less the cash, we get enterprise value. And what you're going to notice, enterprise value has gone from $182 billion to $400 billion over those 8 years. A little piece of debt has grown, but predominantly it's been the share price appreciation based on the earnings. So now we have enterprise value. Now let's look at whether we think the stock is expensive relative to the earnings that we've set up over time. And you're going to know something really, really interesting. Beginning of this tenure, back in 2011, the stock traded for 9 to 10 times EBITDA. In fact, it's 2 solid years, both these years, where it traded at 10x EBITDA, and you could have picked up a phenomenal company, dirt cheap in my opinion, that produced great cash flow, is defensible, all those metrics, and at 10x EBITDA, that is incredibly cheap. As we've advanced and this market that we're in has gotten more and more expensive, that multiple has grown. It peaked at 16.7%. 16.7 times EBITDA, and it's come back down. Now it's trading around 14.6 times EBITDA, and that to me seems like a very decent price to pay for a growing, a well-diversified company. I think this drop that you're seeing of the 16.6 to 14 is probably the baby powder lawsuit that just took a hit on market value, and that's represented the multiple that's trading at. But overall, I think it's still very cheap for a company that is growing top line, could be a bit better, and had you actually bought it these 2 years, that's a remarkable purchase price. Also, one thing to note on the time it takes to realize an investment like this, notice this stock was cheap for 2 years before it advanced more. So don't be in such a rush to go diving into a stock because you think it's cheap, it's going to revert tomorrow. This was here 2 years before it moved up. I've read other value investors, it would average 3 to 5 to 7 years to fully realize an investment. So when you get in, know what you're buying, and then just hang on to it, and eventually it should prove to be right. But this was cheap for 2 years and you could have bought it. Then looking at debt was our final metric, right, to see how much leverage it has. It's beautifully under-levered, which is what we want to see. 0.7, which is less than 1 times debt. All the way currently, it's 1 times EBITDA to debt. And my other note, because they have $17 billion of cash, I'm not netting this debt with the cash on hand. If you took this $28 billion minus the 17, what's that, $10 billion of debt? That's less than 1 times EBITDA. I'm just taking straight debt divided by EBITDA. So to recap on our metrics, top line revenue growth is there. It's low, but it's there. Earnings per share, or excuse me, EBITDA growth, it is there. It's stronger than top line revenue growth. Market multiple, I think 14.5 times is a fair price, if not a cheap price to pay for a company like this. And then the debt leverage, 1x is very low, right? We look for less than 3 times. This is definitely meets that criteria. So I like where this is going. Let's check cash flow, make sure cash flow smells with the income statement. All right, cash flow statement, where the rubber meets the road. So 2011 to 2019, cash flow from operations went from $14 billion to $23 billion. It's a growth rate of 6%. That 6% is in line with the EBITDA growth that we saw of 4%, so it seems to be balancing out. On the CapEx, right, CapEx has gone from 2.8 to 3.5 billion, which is great. What we look for in this channel is the spread between these two, or not the spread, the netting of these two. So as an example, if I take the last fiscal year of 2019, they made $23 billion of operating cash flow from running their business for the year. They had to put $3.5 billion back in at CapEx. That gives us roughly $20 billion of cash flow that's available for debt service and distribution. Now, when you look online in some of the financial blogs or some of the screening tools that are out there, I know Yahoo Finance does this. If you look at their cash flow line, what it typically reports is cash flow from operation minus CapEx. It does not look at the debt payments that they have to make. And some of the companies that are really highly levered, the debt payments are very large and take up a lot of the free cash flow. So be always careful that you look at debt to make sure there's debt after free cash flow. It's typically not done. But what you'll see here in Johnson & Johnson is they made a $2.8 billion debt payment last year. And when we go to the cash flow statement, which is where all fine analysis begins, we're going to take a look and see what they did. So just to give you some bearings, cash flow statement, first third section's operating cash flow always starts with net income, goes to operating cash flow. There is the $23 billion that I have in the other sheet. The line right below this is typically your CapEx, your capital investment in property, plant, and equipment, $3.5 billion. So there's the number. And then the last third is the financing section. So this is where you're going to have all the inflows and outflows of debt. So the cash that paid down debt and the proceeds from issuing debt that they get, as well as the buyback of stock and the dividend. And what you're going to notice is you got the top line here. It reads dividend to shareholder. They paid $9.9 billion. Call it $10 billion bucks. They've got 6.7 that they paid for to repurchase shares. This positive number here and this positive, this is issuances of debt, and they're very, very tiny. Basically, all they did last year is paid down $2.8 billion on their debt, and they didn't issue any debt, which is great to see. And you look historically, even last year they didn't issue debt. The year before that they did issue, but it's really nice to see them making a debt payment, not issuing, not borrowing, which is a rarity in this market. And that's why you're seeing their debt level to be so low on the balance sheet. But to bring it back to cash flow, so here you got $23 billion of cash flow, right? We said that, minus the $3.5 billion of CapEx. That is roughly $20 billion of cash. Now, what do they do with that cash? Well, they come back down here. You said they made the debt payment, $2.8 billion. That leaves about $17 billion left of pure cash that's lying on the ground that they don't have anything to do with. Well, they dividended out 10, and they bought back shares of 6.7. So this is a beautifully simple example of how you can walk through a P&L and it all, cash flow, and it lines up. They generated $23 billion. I'll go back to my sheet. They generated $23 billion. They reinvested in the business 3, that's 20. They paid down debt. That leaves $17 billion of free cash flow. This is what you are buying when you buy a stock. If I divide that by the shares outstanding, I get $6.50 a share. That is the cash flow that you're buying. When they talk about cash flow investing, this is what you're buying. Most people will look at the dividend yield. So the dividend that they kicked out was $10 billion, right? If you only look at the dividend yield, you're missing the bigger picture because the dividend is a piece of overall free cash flow, which in this case was 17. So you would have looked at 10 when really it was 17 and you're missing the bigger picture. So we don't look at dividend yield on this channel. We look at free cash flow. That's one of the reasons we look at it. That free cash flow is a very strong number. Divide by the share price gives us a 4.5% yield on cash. What I want to show here is the power of waiting for a great deal. Remember when we looked at the EBITDA multiples here, and I said 10 times EBITDA was a great price to pay for such an amazing company, and it is. Now it's gotten more expensive, right? If you look up at the yield, remember we just did the math how I arrived yield. It's not inflated because they're borrowing. It's true cash that they've generated and they have nothing left to do with it, so they can dividend it out or buy back shares. Well, back 8 years ago, that yield for the stock was 9%. That is a tremendous yield. There is hard money loans today in the market that aren't yielding 9%. You can buy junk bonds for near bankrupt companies that don't pay a 9% coupon. That's how much money there's in the market that junk companies are trading at yields less than 9%. But here, to buy a Class A growing earnings, cash flowing business and yield 9% is outstanding. And this is an example of why value investors like Buffett sit on giant piles of cash. When they see things like this that may take years to develop, they go diving in and they make that 9% for decades. You would have had that 9 forever, plus owning shares in the company that are growing over time. That is a very, very good way to make an awful lot of money. It has come down. It is richer. I don't know what's going to go in the future, but that was a great deal back in the day. Let's review our numbers here. So top line revenue growth, it's there. Earnings growth by EBITDA, we saw it, it's 4%. Top line was 3%. Debt level, 1 times is a great lever. That there's not much debt there. Well priced at 14.5 times. It's not as cheap as it has been historically, but relative to everything else in the market, this is still a very inexpensive company for what you're getting. And then cash flow is very strong. They have very little debt. As you can see, when they generate the $23 billion after capex, it kind of flows right through to the shareholders. So I think this checks all the boxes. Let's do a forecast and see what the IRR is if we were to buy it. So here's the cash flow forecast. I'm picking up of the 2019 cash flow and I'm growing it 5%. I keep the 5% flat line. Why? Well, 5% is what they've been growing EBITDA at historically. I left it at 5% because it's a reasonable target for a company like this that is well diversified and has been growing in this range historically. I don't know what's going to happen with the COVID vaccine. I don't know what this lawsuit's going to happen, but I think over the long term, that's a very reasonable target. Looking out in the street, what they have, nobody is forecasting that I found a 10-year mark. If they do, they kind of grow for the first couple years, then they hold it flat at maybe 2% or inflation the back half of the decade. And I thought that underrepresents what the company actually has in value. So I kept it 5%. That turns $6.82 into $10.58, and I've used a yield of 5%. So if we look at historically, their yield has been 6.2%. They're currently yielding 4.5. I'm using a 5% yield to come up with a value, which is a reasonable number, and I get $211 per share. Look at EBITDA. EBITDA, the same thing. I kept the 5% growth rate on their last year EBITDA, so 29.4 billion. It grows to $45 billion. In the enterprise value, I'm giving it a 15 times multiple. So historically, its averaged is 12.5, and that's a little too low. I don't think you're going to see this 9x range anytime soon. But if you had, that's a great time to buy. I mean, we talked about market multiple expansion on this channel. That's a prime example. You get a quality stock, and then people run into it, and the market multiple goes from 9 to 15. That means for every dollar of earnings, you're getting, what's that, 4, 5, 6 extra turns on the price. So $1 earnings is $6 in enterprise value. Versus, because it was $1 of earnings is 9 times enterprise value. Now $1 of earnings is 15 times enterprise value. So that expansion adds to your price power and to your return. But back here, so enterprise value $686 billion. It's 15 times the forward EBITDA, less debt, less cash. I've kept that capital stack the same on average. Gives me $666 billion of market cap, less shares outstanding. I haven't changed the shares outstanding. I left them alone. And it gives me $251 per share as the price target. If we look then at where the price is now, it's currently roughly $146 a share. I have two different price estimates, one on a cash flow basis, one on a market multiple basis. I split the difference, I get $231 for a 10-year price. If I throw that into the handy dandy IRR calculator, I get my entrance point, $146. We grow that, you grow that over time to an exit at 231. I get the cash flows that we smell checked before, which are fantastic, and I exit and I get an 11% annualized return over a decade, which is very long-term market, which makes sense. This is a really big company. The stock market's kind of at all-time highs again, so I wouldn't expect outsized returns on companies like this that have a large trading volume or are well-defined. I will say that this is probably, 11% is probably north of what you can expect the market to do going forward. So I do think this could outperform what would be a general market kind of lull for the next decade, just because we are at such a high value. Last thing, you might want to consider this is kind of a value play, rotating some of your portfolio into a company like this that has cash flow, has little debt, well positioned, is going to kind of click along as like a little oil well, if you will. Forgive the bad analogy, but something that just sits there and continues to churn out cash every month, which is a great piece of investment. Lastly, here's our distribution curve. So we're currently sitting at $147 a share. It's 11% IRR. If I keep the forecast exactly the same and just change the purchase price, that's what this curve represents. So as if the stock were to fall back down to $107 a share, given the forecast the same, it would be a 16% IRR return, which would be fantastic. That's back where you'd have kind of that 9% yield. That's a really, really healthy return, and that's when people go all in stocks like this, because it happens rarely, and it is a pretty safe bet. Let's see. So in terms of the rating, let's recap. So we've got top line revenue growth, yes. Earnings growth, correct. Free cash flow, good. Low debt, and a well-priced stock. So we're going to give this a good investment. I think this is decent. It's not going to outperform. We look for things on this channel that have a little bit higher return than this, but because it's such a solid performer and it has so little debt, I really do like it, and I think it's a nice, neat addition if you're looking for a healthcare provider to add to your portfolio. This could be it. Okay, my name is Cameron Stewart, CFA. This has been a review of Johnson & Johnson stock. Please let me know what you think, comment, and hit the subscribe button. Thank you very much for the time. Take care. Bye-bye.